Hello, I'm your host, Patrick Delhougne, and I'm delighted to start this YouTube program, The Patrick Delhougne Show, that will cover your money, global macroeconomic trend, issue as it relates to real estate, and investment in human capital trends. We know that you come to our channel because you value accurate and timely information about the financial world. By hitting that like button, you can show your appreciation for the content we provide. It encourages us to continue producing high quality video that cater to your interest and your needs. Subscribing to our channel, it takes the engagement to a step further. By subscribing, you become part of our community, gaining access to a wealth of financial knowledge and insight. You will be notified whenever we release new video, ensuring that you never miss out on our value information that could impact your financial decision. Episode 3. In today's segment, we will be discussing the recent developing regarding US inflation and the impact of the Federal Reserve interest rate increase that happened last week. So let's dive into the details and welcome to the show. The latest data on US inflation revealed that it was slightly weaker than forecasted in April, providing hope that the Federal Reserve effort to tighten monetary policy are bringing price rise under control, and that's good news. The Consumer Price Index, or CPI, dipped to an annual rate of 4.9%, the lowest level since April 2021. While economists had expected that it would remain at around 5 or slightly above 5%. So overall, this is good news. We see this as a positive step in the right direction. However, while the worst may be behind us, core inflation remains fairly high. And if you look at core services, they are still rising at a solid pace. Lower airline fare contributed to the decline in the headline inflation figure, but certain areas such as used car price remain strong. Also, the price of meat. If you look at the price of meat, last year, meat alone increased by 23%, and this year, since the beginning of the year, it increases by 21%. So in no shape or form we can say that things are under control right now. It is worth mentioning that the overall inflation rate has yet to reach the Federal Reserve 2% target rate, and core inflation, which exclude more volatile food and energy costs, has remained persistently high in recent months. In April, it dipped slightly to 5.5% year on year, but has shown minimal movement since the end of last year. So today, we wanted to cover some major updates on the recent Federal Reserve meeting that took place on May 4th. It was a highly anticipated event. Everybody was really waiting for this important milestone event, as everyone was curious about the Fed's stance on interest rates. Will they hit the pause button or continue their aggressive roller coaster ride to a new height? So let's dive into it. Something important happened during the meeting. The Fed statement was released and it surprised many. I have to say it didn't surprise me because I was expecting this. They removed the statement that they expected further interest rate hikes and tightening. Jerome Powell, the chairman of the Fed, indicated that he wasn't sure if further tightening was necessary, suggesting that they might be reaching the desired level. We all know that the 5% mark was the target benchmark. And guess what? We've now reached a 5.1%, the highest level since 2007. So it seems that we have entered in a phase where we are high and holding high. It seems that we have entered a phase that would be, persisting for at least 8 to 9 months. Powell danced around the topic, but ultimately hinted at a pause. Unless inflation worsen, it looks like the Fed might be done with hiking their rates And Powell also mentioned multiple times that we are now at the level they expected to reach by year end, indirectly indicating that they have reached their target rate. The latest data on US inflation revealed that it was slightly weaker than forecasted in April, providing hope that the Federal Reserve Bank will not do further tightening. It means that the Fed is done with hiking rates, but it doesn't necessarily mean they will be starting cutting rates. And I'm repeating this because this is very important. It means the Fed is done with hiking rates, but it doesn't mean necessarily that they will start cutting rates. So we've entered into a holding phase, and this could be long, and this could be really a protracted period. The market may not like it, but they will have to digest to this new reality. We're already seeing the impact of those policies. Home mortgages have more than doubled, and these car loans are experiencing a significant slowdown. All of this is happening while lawmakers are battling over debt ceiling numbers, potentially putting the US in a default situation. However, we believe that this is mostly political posturing, and inflation remains unconspicuously high. The big question is, when will they start cutting rates? There is a clear disparity between the Fed and the market. The market wants immediate rate cut, but the Fed has indicated that they will hold until further notice. The market is saying, hey, no way, you should cut rate faster. But at the end of the day, the good news is that we have hit the tightening cycle is over, and we've hit a period of pause. This is confirmed by the CME FedWatch tool, which shows that around 93% probability of no rate increases in June, in the June 15 meeting, and only 7.4% of rate hikes. So it seems that most traders that are trading on interest rate are agreeing that we have hit that pause as well. During the meeting, Powell also spoke about the stress on the economy, particularly on the banking sector and households. For the first time, he showed some empathy, acknowledging the impact of his policy. And this is good news because the Fed has been causing trouble, hammering the economy and the banking sector for a long time with the multiple rate hikes that happen very, very fast. To wrap things up, our breakdown of the May 5th Fed meeting and the signal they are sending to the market, it seems that we are entering a holding phase with interest rate, and that this will be a phase that will be, I would say, at least until the beginning of the new year, maybe the first 3 months of 2024. We appreciate you watching our show. Let us know in your comment what you think. Provide us with your feedback. And if you haven't already done so, I invite you to hit the like button and subscribe to our channel. By doing this, you become an active participant in our community and open the door to a wealth of financial knowledge and insight. Remember, your support and engagement matters to us, and together we can navigate the ever-changing world of finance more confidently. Thank you, and see you next time.